Hey everyone, it's Rodney Ross with Limitless Real Estate here today. I'm going to break down, do a little whiteboard analysis of a property that we actually bought in West Philadelphia. This has been almost 2 years now. It's a duplex, 3-story duplex. There's a lot of numbers and a lot of stuff going on here on this whiteboard, so I figured a longer type video like this of just really breaking down every step of the process might help me get some of these concepts through about cash flow and rates of return and all that. So there's 4 parts to this whiteboard. First, we're going to go over the project summary. And then we're going to talk about the construction financing, the hard money loan we got, how much money out of pocket we had to bring to the table, all that. Then we're going to talk about the monthly income. And then we're going to go over the numbers. You can see here the refinance, what happened, how much we refinanced for, how much money we get left in the property, all that good stuff. So this is the summary here. Like I said, this was a 3-story duplex in West Philadelphia, right off 42nd and Girard. Basically, it's funny, this is one of the few properties I wholesaled to somebody and then I actually bought it back from them in the middle of the rehab, so that they wanted to sell it so they could move on to another project. The timing just worked out for them. So the purchase price here, we bought it for $127,000. The renovation cost was just almost exactly $65,000. And the closing cost, transfer tax, title, insurance, all that, was $4,800, right? So the subtotal's about $196,800, a little under $200. We had to pay points, which is upfront fees from the hard money lending company. I'm also adding in here the holding costs, which is about $1,500, and that includes like taxes, maintenance, insurance, builder's risk insurance. This project actually took us exactly 6 months, which you can see here. The last line item here is the interest on the hard money that we borrowed. So we borrowed, we'll get to that section next, but the total interest over the life of the loan, which was literally 6 months to the day, was just over $10,000. And that was us paying 12% times 6 months, right? So our total cost for the project, and you can find these types of projects all around West Philly, these types of properties, we can be all in for around this number. It was about $214,000. So $214,410. That's our total cost. So how do we finance this? We didn't have all the cash out of pocket to put up. This is a lot of money. So what you want to do, if you don't have all the money to self-fund these whole projects, you want to borrow construction financing. And this is a really interesting case study because the construction financing covered more than almost three quarters of the total cost of the project. So we ended up having to only bring $60-something thousand. So we went to the lender, and construction financing is lent in hard money, private money, whatever you want to call it. They lend based off of the final after repair value, which is the ARV of the property. Once it's done, totally rehabbed, what's it going to be worth? In this case, we conservatively thought that it was going to be worth $275,000, okay? So what a lender will say is, okay, it's going to be worth $275,000, I'm going to give you a certain percentage of that. Some lenders will give you 55%, some will give 60%, some will give 70%. This lender gave 65%. The max loan they were willing to give is 65% of that $275,000, which is $179,000. All right. So I added up some of our other costs over here, and I took out the interest and holding costs to show how much cash we need at closing. But if you take, this is the max loan that they were willing to give us, and if you add up our purchase, the renovation costs, the closing costs, the points that the hard money lender is charging us, they charge you usually anywhere from like 2 to 4% of the loan at closing, which you pay the day you buy the property, and then the taxes, which we paid up until the end of the year. We bought this, I think it was in like March or April of 2018. So if you add all that up, the total money that we needed for the project was about $203,000 without the interest, mind you. The max loan they were willing to give is $179,000. So this is really cool because some lenders, and again, some lenders are willing to lend based off of the after repair value. Some other lenders have overlays, and they'll also say, hey, I'm going to give you only a certain percentage of your total project costs. So like some lenders might say, all right, you're going to spend 203, even though I'd normally be willing to give you 179, and you'd only bring about $25,000 to closing, some lenders might say, hey, look, I'm going to cap you I might only give you 150, or I might only give you 165. So this lender was willing to give just based off the ARV, and so we only needed $25,000 to actually close on this property on day one, okay? Now, that's not the total amount of money we need for a project, because you have to add in the amount of interest you're expecting to pay, the holding costs, and then the rehab reserve. I have a star here because you want to make sure you don't forget this. How hard money loans work is when you purchase a property, so you're bringing one amount of money at closing, but you have to spend the money on the property first and then they reimburse you. So like our rehab, $65,000. We spent 20 and then we got 20 back, and then we spent the next 20 and got it refunded by the lender. Then we spent the last 20 and got it refunded. So we put about $25,000 in reserve to make sure we cover the project just in case there's extra costs. So if you add all that up, the total amount of money we needed for this project was $62,000, a lot more manageable than $214,000, okay? So I'm gonna go over, so we bought the property, we rehabbed it, we were able to rent the units out. The top unit, this is the monthly income, right? The top unit rented for $1,350, the bottom unit rented for $1,125. We probably could have gotten more for the bottom unit too if it had been laid out a little bit differently, so we learned on this one. Now, when you're calculating your cash flow, you need to make sure you include like the other major line items. Your management expenses, which is about 6% of the monthly rent. The taxes here, they were a lot lower. It's 2020, so I'm using your 2020 numbers. When we bought this place, the taxes were like $60 a month. And taxes are $177. The insurance is $110, right? This is a big duplex, so your insurance is a little more. If it were a single family home, a lot of new rehab policies we get are between like $60 and $70 a month. So, and then this is also another important one. You want to make sure you're putting 5-10% of the monthly rent aside in a savings account just to cover any vacancy and to cover upkeep. So you can see we put 10% aside, $237 on $2375 is 10%. So you do all that math, this is the income, and then you take this out. Your net operating monthly income is $1,708 a month, or $20,496 a year, okay? So what I like to do before I start factoring the mortgage and all that is you want to figure out what the heck is the cap rate, which is, what's the net annual income over the amount of money that you put in the property, which is the purchase, rehab, and all your other costs. In this case, it's about $20,500 over $214,410. So it's about a 9.6% cap rate. Now, what I'm going to show you is the coolest part about this whole process. What happens when you refinance? Had we purchased with cash, we would have been making just under a 10% return, that's what the cap rate is. We would have been making just under a 10% return annually, and that is not including any of the tax benefits, okay? Now, when you refinance, again, the lenders, a refinance lender, they're going to say, hey, great, you have a place that's up and running, it's bringing in monthly rent, it's stable, I'm going to give you a long-term 20, 25, 30-year loan, okay? They also base the refinance number, the loan amount, off of the after repair value, which is $275 here, okay? So the refinance here, to do this calculation, real simple, we take the total cost on the right side. I put that here just for point of reference. The refinance lender was, I believe, so our price actually, the value of it was $290,000 at the end of the day, not $275. So we undershot it a little bit. So the refinance lender, we didn't max out the loan here, but they said, hey, I'm willing to give you $215,000 to pay off your hard money loan, and then the rest of the money you actually get paid back. Say our hard money loan was only $179, so the rest of the money came back in our pockets. So the refinance loan amount was $215. We had to pay 1% lender fee, pay for title insurance, and I don't have there's one calculation that I might have wanted to add here, but long story short, when you do the math, we got back all of our money except for about $4,000. So I'm gonna let that sink in. I'm gonna say it again. Once we finished the property, we had an asset that was making monthly income, and the lender was willing to give us all of our money back minus $4,000. Okay, so on this last little column here, I put the cash flow here, and this little fine print, I wrote down some of the mortgage terms. So like these are today's terms. We actually are refinancing this property again because the interest rate is so low right now. This is a business loan, a commercial loan. I broke down a couple different terms here. I like 25-year loans. So if you borrow, for example, $215,000 at 4.25 over 25 years, it's about $1,306 a month. And I'm just using this because this is the real number we're going to be using. You can do a shorter amortization, which will give you a higher monthly payment and less cash flow. So if you wanted to do only 20 years, you'd be paying a little more. You'd be paying about $170 a month more. We go for the longer amortization so we can make more monthly cash flow. So our cash flow after the mortgage, all we do is we take the net operating income from over there, and then we subtract our mortgage payment, which is, mind you, this also accounts for this net operating income also accounts for upkeep and our insurance and all that. So this is like the real net income minus the mortgage payment, and we end up making about $400 a month in like net cash flow. And we got all of our money back. Even if we put another $10,000 aside, which is what you should do, maybe I like to go around $4,000 or $5,000 a unit that you should put aside in reserves just in case a rainy day happens. Literally a rainy day and your roof breaks or something, you may need $4,000, $5,000, $8,000. So I didn't put the final return here, but we have very little money invested. We're making $400 a month. So hopefully this gives you some insight on like how investing really works. The beauty of real estate is not just the fact that you can make a 10% return. And again, this is before any tax benefits, and this does not include the property appreciating or any of that, or your rents going up, which naturally happens over time. So you make that return, and then the beautiful part is you can decide to keep that return, but your return, your cash on cash return goes up tremendously. If you pull all your money, if we're making, just to do some mental math, $4,800 a year on $4,000 invested, that's an over 100% return. The numbers aren't always this good. We lucked out on this one. They are often this good for the investments that we make. But if you have any questions about how this works, or if you want me to break down any one of these sections in more detail, please feel free to leave a comment. Feel free to hit the like button, and thanks for watching.